Good evening, everyone. Good evening, good evening, good evening, and welcome. Welcome to our latest Stamford Brown Investment Markets Update. Are we there yet? For those of you who don't know me, my name is Vincent O'Neill and I'm the CEO of Stamford Brown. Tonight is a special event, and it is, of course, the first investment briefing by our new Chief Investment Officer, Nick Ryder. Welcome, Nick. Welcome to you, our clients, but also to any friends and colleagues that might be joining one of our events for the first time this evening. I'd also like to warmly welcome our professional partners who are in the room across the accounting, property and legal sphere. We greatly value your expertise and partnership in delivering outcomes for our clients, so thank you for joining us tonight. Before we begin the formal proceedings, importantly, I would like to acknowledge the traditional owners of the land on which we meet. This is the land of the Gadigal people of the Eora Nation, the custodians of the place we now call Sydney. I would like to pay my respects to the elders, past, present, and emerging, and respects to all people here today, wherever you may come from. In terms of our planned running order tonight, Nick will speak for approximately 30 minutes, followed by some Q&A, and then there will be further drinks and food served from approximately 7 o'clock to 8 o'clock, so we hope you can stay and enjoy a drink and a chat with us. Before turning to investments, I do want to premiere to you something that we have been working on. As you will be aware, about 2 years ago, we updated our website and our branding. Now, there was a lot of jokes about that at the time because Stamford Brown became very green, and that was about 2 to 3 weeks after I took the job as CEO, but I can assure you that was in train long before then. The primary motivator of that rebranding was to better articulate what we value most in our work with you, our clients. The following video builds upon this work and has been created for our website as a window into our work, allowing you to hear from some of our partners on their client experiences. Ultimately, the video will speak for itself, and we hope that you enjoy it.
People often ask, what is wealth? While you get rich, that's passive. You build wealth, which is proactive. It implies purpose, planning, and process. It's strategic. By definition, wealth has longevity, it's intergenerational, and it has aspects of philanthropy.
Wealth invariably comes from hard work and success. It's often about investments and portfolios that we run here, but ultimately when I think about wealth, it's about the options that my clients have.
Wealth. Well, obviously it's your money, your investments, and your structures. But it's much more than that. It's the link between your money and your world, be that your family, your business, intergenerational, philanthropy, and much, much more.
I work with a wide range of clients who each have their own stories. What they share is that they are engaged, fulfilled, and successful people. And while they care about their wealth, it doesn't define them.
Clients value the fact that we're across the entire balance sheet, not just a single portfolio. I often get involved in paying their tax, looking after invoices, understanding deeply their cash flow. We effectively become a CFO for each of our clients.
The work, obviously there's a technical. We work on the structures, the investments, and making sure that we've covered off all the key things that we need to in that regard. But ultimately, where we probably add most value is the emotional side of the work, helping them understand what they want to achieve for their children, helping them plan for the next generation, and helping sometimes navigate those unfortunate life circumstances that hit us all. We are there to help guide them through it.
A Stamford Brown advisor is on top of their game. We are fair-minded and we genuinely want the best for the clients we service. We are empathetic, authentic, and professional.
A Stamford Brown advisor is someone who can lead with their head and their heart. They should have the intellectual ability to run a portfolio of complexity, but also the emotional intelligence to be able to understand that families and kids aren't always simple.
We are very lucky to get to do what we do. We actually have an incredibly trusted relationship with our clients. We get to talk to them about the things that they can't talk to anyone else about. Sensitive subjects such as family, such as money, through many life transitions, selling a business, changing a career, losing a loved one. That trusted place, that work that we do together, it can never be replicated and it can never be understated. And ultimately, that is really rewarding work. It is about trust, it is about intimacy, and it's about delivering results that have a meaningful impact on our clients' lives. now to the important issue at hand. Investment markets. 2022 was certainly a difficult year for investors, including us at Stamford Brown. As the CEO, let me say one thing clearly. We never take our role as custodians of your family wealth lightly. 2022 saw that wealth exposed to volatility, and that is something we are always determined to minimise. I want to reinforce to you that we take this work and responsibility to you and your families very seriously, especially at times like this. Before welcoming Nick, I do want to introduce you to another significant addition to the Stamford Brown team. We are delighted to introduce Joey Murakadi, who joined this month as a Senior Investment Director. Joey brings wonderful experience over a couple of decades working in global markets across firms such as RBS Global, UBS Wealth Management, and Credit Suisse Private Bank. Most recently, Joey was a Senior Investment Advisor at ANZ Private, where he spent the last 5 years. The addition of Joey builds on our commitment to delivering investment outcomes for clients. Would you please join me in welcoming to the Stamford Brown team, Joey? Where are you? Give us a wave. Lastly, I want to highlight our ongoing communications which you should be receiving. We regularly send out our monthly investment report on the first week of the month, our podcast, now slightly shorter form, but twice a month. Those of you that are familiar with the podcast knows the previous routine that myself and Ashley had. Generally, I would ask a question, he would talk for 30 minutes, then I might get to move on to question 2. I've had a couple of dry runs with Nick. It appears that he talks for about 7 to 10 minutes. So for those of you that have maybe found the 30 minutes a little too long, I can reintroduce you to the podcast, give it a try. It is shorter, but we'll be doing it about twice a month now. We have our Stamford Brown News Wrap on the last week of the month, as well as our quarterly investment and our many white papers, which hopefully you've enjoyed. For example, How to Balance Your Retirement and Helping Your Adult Kids by one of our advisors, Kirsten. How Much Do I Need in Retirement and Will I Have Enough by one of our partners, Andrew Griffin. And we have a number of these to share with you actually by the door tonight if you want to take one of those and have a read and delve a bit deeper. You should be receiving these communications pretty much on a weekly basis. And if you're not, please let your advisor know ASAP so we can make sure that you are. Now, to the main event, welcoming Nick Ryder. During the extensive recruitment process, we were drawn to Nick's deep and broad expertise building over 30 plus years in the investment management and financial services industries. I can share with you that this wasn't a sort of a rushed appointment. Hamish and I actually met with probably over 10 candidates that were personally recommended to us over the course of about 9 months. And then through that process, we were looking for many qualities. Obviously, we're looking for technical expertise and a proven track record. But we also wanted someone that fit our culture and our values and that we could see that could be a significant part of adding value to our business, not just today and into the future. And our top candidate in that search ultimately was Nick. Sorry to embarrass you there, Nick. So we are delighted to have him on board. He's over 30 years in the investment management industry. After an early career in corporate finance and hedge fund investing, he held alternative investment director roles at Citigroup and NAB. Since 2009, he's been a senior investment strategist at Commonwealth Bank, JB Weir, and NAB. In those roles, he's held a comprehensive range of responsibilities, including strategic and tactical asset allocation, economic analysis, portfolio construction, and investment selection. Nick is also particularly passionate about helping clients grow and preserve their wealth, ensuring that they have a strong understanding of how their money is being invested. And that was one of the key things that appealed to us, his communication skills and his passion for communicating with clients. Can I please ask you all once more to give Nick a very warm welcome, and the stage is yours. Thank you, Nick.
Thank you, Vincent. Yes, well, that's 30 years. It makes me sound quite old, but people say I look a lot younger than that. What I want to talk tonight about is a couple of things. So the agenda is to talk about my views on portfolio construction, and Vincent touched on my passion for talking about strategic and tactical asset allocation and how that applies to client portfolios. I'm going to talk a little bit about that. I think what I want to cover also is some of the questions that I've been getting from clients, particularly over the last year or so, on fixed income. And then, what's happening more broadly with inflation. So I'll then talk about sort of the macro outlook, our views on inflation and very topical interest rates and how close we are to the end of the interest rate hiking cycle. And I guess that's the theme for tonight. Are we there yet? Are we near the end? And then finally, I guess I'll talk about what all that means for the different investment markets, how we're seeing it. And I also want to talk about longer term themes that we're kind of looking out over the horizon, what might be coming longer term and how we might build portfolios to better kind of deal with some of those longer term themes. So starting with portfolio construction, and I think they've aptly chosen the boat idea, and a lot of what we do is working with clients to set a course, a long-term strategy for their wealth. How they're going to achieve their objectives, and that's really how I think about strategic asset allocation, building the portfolios with the weights to the different asset classes that will best help clients achieve that objective. And that objective might be, I want a certain return or a certain income, or I want to leave money to my grandkids, or I want a certain level of risk in the portfolio. So there's a lot of different objectives that often have to be traded off. But the big thing with strategic asset allocation is the power of diversification. And we all know, we've heard about diversification, and forgive me if you can't read all the numbers on this slide, but the important thing is that different asset classes, like cash, like fixed interest, like hedge funds, property, infrastructure, equities, they perform well at different times in the economic cycle. And we don't have a crystal ball. We don't know what's over the horizon, what next year might bring, and which is the best performing asset class, which on this table is in green. But what we do know is that by blending different asset classes, we can get a better outcome for clients, because some things zig when other things zag, and so not everything is moving in the same direction at the same time. And we use that in our industry. We talk about something called correlation. It's basically a measure of how assets move together. And so when we build portfolios for clients, we want to find assets that are not moving together. And I've also often found clients, they don't really understand diversification. I've had clients at previous roles, they've come in and they've told me, oh, Nick, I'm diversified. I've got all 4 Australian banks, and I've got bank term deposits, and I've got bank listed hybrids, and I have a couple of investment properties, usually in the same suburb that they live in. And I go and explain, well, you've basically got the same risk, 5 different ways or 7 different ways. It's basically Australia's housing market risk, and I explain that they're not diversified. And then so we go on the journey of getting them properly diversified. But that is quite a typical thing that we do see, particularly with unadvised clients. They have term deposits, cash, Australian shares only, etc. So we want to diversify clients. The other thing I think is interesting about this, and this is particularly something that I'll touch on, is cash is usually the worst performing asset class. People like cash, they say cash is king, but generally it's the lowest risk asset. It's also usually the worst performing, and you can see on that, you have to go back to 1994 for cash to be king, basically. So moving on, how do we build these portfolios that are nicely diversified? We use a combination of working out what the objectives are that we're trying to achieve. And as I said, they can be many different things. They can be returns, they can be risk, and we sit down with our clients and we understand what's most important to them. And usually they say, Nick, I want it all. I want, high income, no risk. I want instant access to my money. I want to pay low fees. And I say, we can't have it. It's like the wonky table. Pick one, pick 2, and we can work on that. And the others will have to take a back seat. So it's just trying to find that right balance between different client objectives. Then what we do is we work with our asset consultants. So we use Jana, who are leading investment asset consultants in Australia, and they provide us with a lot of data on forecast returns. So they have some models that they use to forecast returns for different asset classes over an investment cycle, which is usually sort of 10 plus years. And they have these correlations that I mentioned. And we put all of that into what's called an optimizer. It's a mathematical, computer-driven optimization process, and it finds the portfolios that achieve the best return for each unit of risk. And that's what that green line is. And it's interesting that that green line, the best portfolios, is better than the sum of the parts of the individual asset classes, and that's the power of diversification at work there. It's like, you know, the cake ingredients, they taste terrible on their own, but when you blend them all together into a cake, it actually is a much better outcome. And so that's what strategic asset allocation is all about. As asset allocators, we've had a great, very easy time in recent years. We've had 30 years of falling inflation, and falling inflation has been driven by a whole range of different things. We've had the internet revolution and smartphones. It's made it cheaper for us to find goods very quickly and cheaply online from all sorts of different countries. So that's lowered the cost of goods. We've had the entry of China and India into the World Trade Organization in the late 1990s. So we've increased effectively our production base and access to cheap labour in many of those cases. We've had the peace dividend following the fall of the Berlin Wall. Countries haven't had to spend as much on defence, and that's been generally deflationary. So there's been a whole lot of different forces at work over the last 30 years. And at the end of my presentation, I'll talk about whether some of these might actually be going into reverse, you know, and that's what we do worry about, that we'll go into a more inflationary period going forward. But obviously inflation has been a big problem lately, and that has hurt all asset classes. Last year in 2022, everything went down because interest rates went up very aggressively. That hurt bonds, that hurt property, it hurt equities, it hurt pretty much everything, because the risk-free rate is the rate by which we compare every other asset class. And if instead of getting 0%, you're getting 4% on your cash, then that makes everything else less valuable. And so it's been a very challenging time in last year for people like me who are asset allocators, because assets suddenly became correlated. As I mentioned, I wanted to talk about fixed interest just briefly. I do get a lot of questions from clients about it. You know, why wouldn't I just have cash? Or, you know, I had a negative return from fixed income. It's meant to be a defensive asset class. Why is this so? So there's a lot of work that we need to do as advisors to explain how bonds work to clients, and that there's an inverse relationship between yield and price. Yield goes up, price goes down. But generally, with a bond, you get your money back. You know, government bond, you get $100 back at the end of the term, whether it's 3 years, 5 years, 10 years, whatever it is. The price today might be lower, but you're still getting your $100 back. So it's still defensive, you just might have to wait a little bit longer for its defensiveness to shine through. The other thing that chart shows is that you've always been better off being in fixed interest relative to cash. If you had cash and just rolled it over every day or month, if you had a 1 month TD or whatever it might be, versus holding a government bond that was 5 years, you're always better off in that 5-year bond, generally, over the last 30 years, because we've had falling interest rates. Those bonds became more valuable. We also generally have an upward sloping yield curve, so the market pays you more to lock your money in for longer relative to cash. So that's another reason why you hold fixed interest and not cash. You've been better off, you've been paid for it as an investor. You've been better off being in fixed interest. As a borrower, it's been the reverse. You've been better off being in variable interest rate mortgage rather than fixed rate mortgage over the last 30 years. The other reason why you hold bonds is what they call the negative correlation. Now, I mentioned correlations all kind of went up last year because of the inflation spike, but generally, over the last sort of 20 or 30 years, the correlation between bonds and equities has been either negative or very low. So when equity markets fell, particularly during the GFC and COVID and all sorts of other periods where equity markets fell, you generally found people switched into the safety of a government bond, and that pushed the price of those government bonds up. So that's sort of what the chart on the right is trying to show, that negative correlation. So I think of bonds as a form of portfolio ballast or portfolio protection or insurance. And they still have a very important role in client portfolios, even though the last year was quite difficult if you're an investor in bonds. You know. The other thing we try and do with portfolios, and it's very difficult, is what we call market timing. But we do it in small ways. We call it, it's like trimming the sails on a boat rather than a sharp change of tack. Basically what we're trying to do is add a little bit of value to client portfolios by timing. But what we don't want to do is what a lot of investors left to their own devices do, which is when the stock market falls, as the chart in the left shows, people panic, switch to cash. That's human nature. They've had pain. They don't want that pain to continue. And then they often miss the rebound. And the chart on the right shows that if you stayed fully invested in the US stock market for 20 years, I think it is, you earned a 10% return, roughly. But if you sold out and you missed some of the best days in the market when things rebounded, your return was a lot lower. So many of you might have heard of the expression time in the market, not timing the market. But we actually do want to time the market. If we can buy when markets are down and everyone's panicking and then capture the return, then we can add value to client portfolios. So we do try and do market timing, and we call that dynamic asset allocation. And that's the process of tilting the portfolios to try and take advantage of what we think markets are likely to do. And we look at a range of different factors. So we look at what's going on in the economy with inflation and interest rates and recession risks and growth. So that's the economic fundamentals, and I'll talk a bit about that, how we're seeing that at the moment. Then we look at valuations. Are markets cheap or expensive? That's an important driver of markets, particularly over the longer term. We look at risks, COVID waves or recession risks or geopolitics. There's so many risks that are out there. Some we just don't know about. They're the known unknowns. And then investor sentiment. Are investors greedy or fearful? Because we generally want to be doing the opposite of what every other investor is doing. So they're the sort of four things that go into the mix when we underweight or overweight different asset classes. So obviously inflation has been a big thing over the last couple of years. The good news is it looks like it's largely peaked everywhere. Maybe not so much in the UK. Their numbers came out last night. They were still pretty horrendous. New Zealand's came out earlier today. They were pretty good. They were a bit lower than expected. And we'll get ours in Australia next Wednesday. Australia's still playing around with a monthly inflation number. It's not fully developed, so we don't place a lot of weight in it, and we're still kind of locked into the quarterly number. So that quarterly number will come out next week. But the good news is it's peaked and it's heading back down. The issue for me as a CIO and strategist is how quickly will it get back to central bank targets of 2%. The RBA is not predicting that will happen for another 2 years. It'll just kind of sneak into the top end of their 2 to 3% target range in mid-2025. And that's based on probably further rate rises from here. But the good thing in Australia is we don't have a wages problem yet. Most other countries have a wages problem. Wages in the UK are growing at around 6 to 7%. In the US, they're still pretty high wage growth. And that's what central banks want to stop, is that wage price spiral where people go to their boss and go, oh, inflation's 7, I need an 8% pay rise. And then so they go, oh, okay, 8% pay rise, and then I need to charge my customers 8% more now because I'm paying you 8% more. So it just becomes this vicious cycle. So that's why central banks are very keen to stop that happening, and that's why they've been as aggressive as they have to try and bring inflation back down and stop inflation expectations becoming unanchored. At the moment, union officials in Australia think there'll be 5% inflation over the next year. So when they go into wage negotiations, they'll probably start with a 5 or maybe even a 6 in front of it. So the central banks want to try and stop that. And Australia has a wage setting system that's quite different to other parts of the world. Our wages tend to be quite sticky because of the 2-year enterprise bargaining agreements and the way the award works, annual reviews and things. So I think of the inflation problem as in 3 parts. Some of it was transitory. So, Jerome Powell, the Federal Reserve Chairman, He abandoned the word transitory, but some of it definitely was transitory, was related to COVID. Everyone's stuck at home, buying electronics, and hey, guess what? There weren't enough workers or there weren't enough ships, or there weren't enough aircraft to deliver all those goods we were buying online. So it was really the supply chain problems and the excess demand for goods that was due to the pandemic, and now, fortunately, that looks like it's cleared. We don't really hear people talking about supply chain problems anymore. The second part of the inflation story was the war in Ukraine, pushed the price of oil and gas up, and food. Food prices, wheat, corn, etc. One of the biggest inputs into those is the price of oil. Fertiliser comes from gas, which is related to oil price, and diesel to transport, for harvesters and to transport the food around. So, and of course, Ukraine and Russia are big wheat and grain exporters as well. So that seems to have reverted as well. So that's the good news, and that's why inflation has largely peaked. The bad news, and this is the chart on the left is from the US, which kind of decomposes their inflation numbers into those three parts. So I can't quite see it here, but I think the light green line, which is -1, is for goods, related to goods. So that's the ordering and supply chain problems. The darker green line is food and energy prices. So that's come down. But the final part of the puzzle, and this is what central banks can't really fix the first two bits. They can't help supply chains and they can't help do anything about the war in Ukraine. But what central banks can do is the last part of the puzzle, which is services. So that's the part that's stickier, and that's why I fear that inflation might not come down as quickly as we would like, because that would require people to lose jobs. We have very tight labour markets in most of the world, Australia, US, Europe, and services, the price of services, so restaurants, think about anything, there's still, a lot of restaurants are still full, hotels, travel, all of that services. And that's related to people's confidence to spend, and their jobs. And also a large part of it is rent, or what they call shelter costs in the US. And that's also slower to change. That is interest rate sensitive. So I think we've still got a bit of work to do on that. And I know when we get the inflation numbers next week in Australia, rents will still be going up at quite a rapid clip. And obviously electricity is still a big problem. So I think it could be a while before inflation comes back down. As I mentioned, the labour markets are very, very tight. So 50-year lows in the US unemployment rate, similar in Australia. In the US, for every unemployed person, there's almost 2 job openings. You can see that in the chart on the right, job openings. About 9.9 million job openings, and there's just not enough workers, and that generally leads into wages going up. So what the Fed's trying to do is slow the economy, kill off a lot of those excess job openings, but hopefully not necessarily lift unemployment. But they can also lift unemployment so that the two kind of meet in the middle, and that's, I guess, why people are worried about a recession. In Australia, similar story, but as I mentioned, wages have not been a problem yet. Although in the RBA minutes that came out last week, they did highlight that maybe later in the year will still wages go up even more, particularly for government workers and with, nurses and a lot of those healthcare workers that, they want to attract. They need to probably increase the wages there. So recession risks, generally when interest rates go up a lot in the past, that's led to a recession. Unemployment doesn't go up by a little bit. Once it starts moving, it normally goes up quite a lot. Someone made the comparison with pulling a brick with an elastic band. It doesn't necessarily move, and then it suddenly starts to spring, and that's what can happen with unemployment. You can't just fine-tune unemployment. Even though they're trying to do that at the moment. The other thing I worry about is there's still a lot of elevated savings or pent-up pandemic savings. We're all stuck at home. Yeah, we bought stuff online. but a lot of that savings is still out there. Yeah, some of it's been used. So in the US, you can see the estimate of pandemic savings got up to $2.5 trillion. It's come down, but there's still money there. In Australia, it's about 200 billion that's estimated to still be hanging around from all that stimulus, all that money sloshing around in the system. We also know in Australia, a lot of people took out fixed rate loans. So, we're not as sensitive to rates until those loans start to roll off. In the US, 90% of mortgages are 30-year fixed rate loans. So they're not as sensitive to raising interest rates. So this is what I worry about, that we haven't really seen much impact yet from higher rates in the data. People are still spending. You can see that in the chart on the right. The dark green line is the volume of retail spending in Australia. So that doesn't include inflation, that's just the number of goods people are buying, and it's well above its pre-pandemic trend. Even still, it hasn't reverted to kind of normal levels. So there might be a bit of revenge spending going on, people taking a few more trips, and that needs to work its way through. But people are still spending, We do know some people are, suffering, particularly at the lower end of the income spectrum, with a high cost of living. But yeah, it hasn't really started to have much impact yet from the rate rises we've seen. So that's why I worry that rates might actually need to go higher because of this. Most economists think, it's all going to be fine, inflation will come back down and interest rates will go up a bit more and then they'll start cutting them. So that's the current consensus view in markets, that's going to happen. Obviously, we've had the Silicon Valley Bank issue in March, and that's at the margin, particularly in the US, means that there'll be tighter lending standards. So that's done some of the Fed's work for it. If banks are more cautious about lending, then that's kind of like an interest rate rise. So that's quite good in the US. But Australia, it's not, we don't have those problems. We haven't seen deposit outflows. Our banks are unquestionably sound, according to the RBA. Even though the banks mightn't pass on all the interest rate rises to depositors, people aren't pulling their money out and necessarily en masse that they have been in the US. So the market is often a bad predictor of recessions. They say markets have predicted 9 out of the last 5 recessions. But the bond market's not bad. So the chart on the left shows the difference between a 2-year bond in the US and a 10-year bond. And whenever the 2-year bond yield is higher than the 10-year bond yield, so the yield curve becomes inverted, generally, as you can see in the chart, there's been a recession within sort of 12 to 18 months. And so the bond yield curve has been negative for quite a while now. So the bond market definitely thinks that there's going to be a recession, that the Fed will have to cut rates, that they'll be too aggressive. Economists, they're kind of split. 60% of economists think there'll be a US recession, it'll be pretty mild. And Australia will avoid a recession, according to the average economist, but it'll feel like a recession. It'll be a per capita recession because migrations come roaring back. So our population is going to grow 2% over next year. So 1.5% growth, or whatever it is, the economists are predicting is a per capita recession on a per person basis. So in terms of asset classes, the chart on the left just shows kind of what markets were pricing before the Silicon Valley Bank weekend, and they thought that the RBA would lift rates another 3 times, from 3.6 to about 4.4%. But in the last month, they're now saying, we think the RBA is probably done, maybe one more rate rise is likely. As I said, we don't have the same issues that US regional banks have, So I think that's quite a big turnaround. And I was reading the minutes of the RBA meeting the other day, and I think they're not done yet. They've still got at least one of them, one more rate rise, maybe more. It just depends. Maybe next week, if the inflation number's a shocker, we'll be looking at maybe going back to where we were for market pricing. So I would be underweight fixed interest still. bonds, fixed rate bonds, just because I think we're probably not quite there yet. Same for other markets. You know, they've probably got a few more rate rises still there, but if the data just doesn't show inflation going back to that 2% quickly, then yeah, maybe more work needs to be done. For equities, it's not really great for equities at the moment. They've done okay because bond yields came down during March, so that helped support equities. So equities are kind of held up there. I think a lot of people are kind of keen to buy the dip, and we've seen that quite a lot. So equities, every time markets go down a little bit, people kind of jump in there. But earnings, which are one of the big drivers of equities over time, are going to be pretty flat this year. Company profit margins are shrinking. You know, they just found last year they could pass on price increases, cost inputs and labour. This year they're finding it a lot harder to put through more price rises. So profit margins, which is the chart on the top left, are coming down. And the chart on the right shows the average earnings for different financial years for the global equity market. And the grey line is this year, and it's basically saying it's going to be the same as last year, 0 earnings growth for global equities this year. We're in the start of the US earnings season, and earnings are actually going to be lower in the US this quarter compared to the same quarter last year by about 7%. So earnings aren't going up. Bonds, as I said, maybe you have a little bit higher to go, so that kind of means that, yeah, probably not a great environment for equities. If you think about equities as being driven by bond yields or bond prices and earnings, then neither of those components are necessarily suggesting a big lift in equities this year. Valuations relative to history are about average. They're a little expensive in the US, but maybe that's justified because US earnings are less volatile than a country like Australia where we have a lot of mining related earnings. So maybe that demands a bit of a premium in the US, but most markets are around kind of average valuations. But relative to bonds, they're actually less attractive, you know, because bond yields have gone up. So as I said, the risk-free rate makes every other asset class look slightly less attractive. So the risk premium on equities is actually quite low, particularly in the US. That's what the chart on the left is showing. In terms of Australia, Australia is very much a value market. So I sort of don't have a strong view of the value versus growth. Value had a great run last year, but that's faded this year. Value does well when growth is abundant, and you know, in an inflation environment, in an environment interest rates are going up, value can do quite well. But this year, where growth is slowing and inflation's coming down, it maybe the tailwind for value isn't as attractive, and therefore, yeah, I probably wouldn't have a strong preference to be in Australia versus the rest of the world. In terms of sentiment, that's the other thing I mentioned as a driver of kind of how we think about markets. We have a bunch of different sentiment indicators. The one on the left kind of uses a composite that I've built. It takes into account, you know, how many people are buying put options to protect their portfolio. What's the volatility of the market, which is often what they call the fear gauge. So it takes 7 different things and kind of puts it into one number, and tries to work out whether people are greedy or fearful. So it's sort of neutral at the moment. And then do surveys of investors in the US. Are you bullish or bearish? And they're slightly bearish at the moment, but not a lot. So I would say sentiment's kind of neutral as well. So when I kind of summarise all of that up, kind of neutral on equities, maybe slightly underweight, and slightly underweight bonds, as I mentioned, for the reasons I mentioned. And we're overweight alternative investments. If you can't, all of this table, I think we'll send this around to people that want it, but also a lot of it's in the document that I wrote earlier in the month, if you're interested. So just quickly on the longer term themes, you know, are we going to see any more inflationary environment going forward? You know, I talk about the Ds, you know, demographics. We all know that we've got an ageing population, and that is a headwind. Fewer workers leaving the workforce, fewer taxpayers, means governments are more constrained. So So demographics is not on our side. After the 1980s, we had all the baby boomers and women join the workforce, and that was great. They increased output. But going forward, some of those things are going into reverse, particularly in China. They've got a huge demographic problem. Debt is another problem. Governments have taken on a lot of debt, particularly during the pandemic, and just their wiggle room to provide stimulus is probably a lot lower. They probably want inflation to run hot because that deflates the real value of the debt, so that kind of gets them out of the debt problem. That's what happened after World War II. So debt is probably another bit of a headwind for things, but also probably slightly inflationary at the margin. The other thing is we hear a lot about de-globalisation, and definitely globalisation peaked, probably about 10 years ago, just after China and India entered the World Trade Organisation. It's going into reverse, and a lot of companies now are talking about supply chain security, friend-shoring, near-shoring, all of that. That's inflationary. If you're replicating factories in a lot of different countries rather than having big one for economies of scale, that generally would tend to push up prices. So deglobalisation, potentially inflationary, and the other thing is defence. We've had quite peaceful time over the last 30 years, as I mentioned, but now with what's going on in China and Russia and these blocks potentially, countries are needing to spend more on defence, and we know that from Australia with AUKUS submarines, etc. And that's potentially inflationary as well, because all those submarines, there's a lot of steel and commodities and things that have to be mined, so it just increases demand for a lot of those sorts of things. The other things are a bit sort of more nuanced, so decarbonisation, another D. On the one hand, that's inflationary because we need to have a lot of copper and lithium and all those things to electrify the network. But longer term, wind and solar is a lot cheaper source of power than fossil fuels. So I think that one's sort of, I've got a question mark over whether that's inflationary or deflationary. And also automation. Labour productivity has been terrible in recent years. So we haven't been able to increase the supply at the same rate as demand, and therefore that's potentially inflationary. But if we can replace ourselves with ChatGPT, we can potentially, squeeze more out of the productivity bucket. So I think that one's also a bit more mixed. But if productivity continued to decline, that would be inflationary. So that's it for my presentation. I think I've gone a bit longer than half an hour, but.
Thank you, Nick. Thank you. Stay with me. A little longer than half an hour, albeit probably still half an hour quicker than Ashley on his best day.
Yeah.
Huge amount of content there, and we will throw to the floor and take a number of questions. But I'm going to ask you to actually go back and talk through one of your charts, because I think it's quite interesting, and that is actually your one on the 20-year ranges of equity valuations, current valuations, and sort of where you see some of them. So if we can click our way back to that one, which is probably about back, because I think it's just a good one to talk to the room. That one, that's it. So we're looking at the chart here. I might ask you just to take a moment just to talk a little bit further. So I'm talking about this one, and take everybody through what you're looking at there. And when you look at valuations now, what are the averages? What are the ranges that we've seen? And just help explain that as a starting point.
Yeah, so what that is what's commonly referred to as a price to earnings ratio, and it's sort of the shortcut method by which we often value equities. So it's taking the current price divided by the earnings and saying, what is that multiple? So in Australia, the average multiple, I think, has been around 14, 15, something like that over the last 20 years. Now, it was a period where interest rates were quite low, so we need to kind of account for that, and that's why they have that other chart that then also compares against bond yields. But that's basically what that chart's showing you. What's the highest it's been and what's the lowest it's been over the 20 years. The
green dot being where it's currently at versus the black line being the average, and then comparing that average to 6 months ago.
Yes, that's right. So that's right. So if we'd have gone back to late 2021 in the US, we would have been at the top The US market would have been close to 22, 23 times earnings in November, December 2021. So it's derated a lot, but as I said, it's still a little on the expensive side relative to history.
And you touched on growth versus value there. Do you mind just unpacking for the room just a little bit more about what you actually mean that? So when you're investing in shares and you think about growth investments versus value, what does that actually mean?
Yeah, so it's actually, that chart's actually not a bad explanation. So when we talk about value, we're trying to find stocks that are cheap. So on that metric, maybe you'd look at Japan, where the PE is quite low relative to other countries. So value is just the style of investment, trying to find cheap stocks, and growth is the kind of opposite, saying, well, we don't care what it's valued at. We just want to buy companies that are growing more quickly than the
So a
average.
value company has great cash flows, sustainable earnings,
Yeah.
but not necessarily growing all that dramatically.
Yeah, and so the US is more of a growth market. They've got more tech stocks in their market, the Apples and Amazons and Netflix and Teslas and all those are growth companies, and that's why it tends to be more expensive than places like Australia, where we've got banks which are value stocks and miners which are value
Maybe
stocks.
talk a bit about why growth stocks did so well in recent years when interest rates were very low as well.
Yeah, so with a growth stock, a lot of the earnings are far in the future. And if money's free and interest rates are near zero, well, you're happy to pay the same for profits in the future as today. So those companies are quite valuable in a low interest rate environment. But as interest rates went from 1.5% to 4% or 3.5%, the value of those stocks fell the most sharply because the earnings are far in the future. Value stock, like a bank or a miner, earnings are here and now. People aren't going to pay up for future iron ore prices. They'll pay for what's currently earning.
So probably in a way, when we think about it, we've got certainly the low interest rate period and certainly the post-COVID zero interest rate period where the earnings, your cash flow, your profitability today for a period of time mattered a lot less. Hence why we saw some of the technology stocks, some of the speculative assets go through the roof,
Yeah.
albeit 2022 saw a bit of a reality check in that space.
Yeah, absolutely. It's been great to see some of those meme stocks that were never going to make any money come back to what they should be worth.
A great
Zero.
I told you so moment for you.
Yeah, there's a bit of that.
And just while we're talking stocks and earnings, you touched briefly on Silicon Valley Bank. I know we covered it off in our most recent podcast, but can you explain for the room why, at the time there was some commentators or people that were fearful talking about this is the next GFC, we're going to see a follow-on run on banks following Silicon Valley Bank, and why in reality that hasn't played out. Certainly there's been a few flash incidents, but why you see that different to the mortgage-backed security situation in 2008, 2009?
Yeah, so the problem with the banks was nothing to do with poor lending. The asset side of their balance sheet was fine, apart from some long-dated bonds they had, which they had to revalue. But generally it wasn't the problems that got banks into trouble in the GFC, which was, ninja loans, no income, no job, that sort of stuff. So it wasn't a traditional banking crisis where there'd been poor loans.
There hadn't been a property speculative
No.
bubble driving this one.
And then if you drilled into Silicon Valley Bank, I mean, they're a very unique bank that got into trouble for their own particular set of circumstances. They had run out of things traditional loans to make, so they were forced to buy these 30-year bonds, and then when interest rates went up a lot, those bonds were worth a lot less. They also had a very concentrated depositor base.
A lot of venture capital funds.
That got onto Twitter and said, oh, we're worried about Silicon Valley Bank, pull your money out. And so 42 billion got withdrawn kind of same day because people could go onto their apps. And so once that happens with a bank, it's game over. There's no way a bank...
Bank run in the digital age.
Yeah.
And why does that give you confidence that that's not a sort of a systemic issue that...
Well, as I said, it was specific to Silicon Valley Bank, the composition of its depositor base and the composition of its assets with a large weighting in securities. Most banks try and make real loans. But the
Timing-wise, coincidentally, though, you'll say then we had the Credit Suisse situation play out only days later, a couple of weeks later at max.
Well, I think what happened is investors started going hunting for the next weakest bank, and they found Credit Suisse, which was hiding in plain sight, really. and
Had issues for
had
quite some
issues for a
time.
long time. Yeah, but unfortunately, banking is about confidence. We all trust that if we go to the bank and put our card in the ATM, that we'll be able to pull money out. But the reality is, most of us never want to pull money out. But if enough of us all get together and decide we want to pull our money out, there's no bank can survive that, really.
So we talk about equities here. You certainly set your stall out in terms of making the case to not sell all your bonds. Don't give up on fixed income, go back to cash, particularly as yields come back. You also then talk about alternatives, and in your bio I talked about some of your background in alternatives, but it's not an area, well, one, it's a very broad area, and two, it's can be opaque and will not really mean anything to most people in the room. So can you mind sharing a bit more about where you might invest in that space and why you would do it?
Yeah, so alternatives, it's a catch-all term. It's anything that's not traditional. What's traditional? Well, equities, bonds, cash is traditional. Property kind of sometimes gets thrown into alternatives, but certainly things like hedge funds, private equity, private credit, infrastructure can be part of the alternatives bucket. So it's really all our other stuff. And what's it trying to do in a portfolio? It's trying to be a diversifier as well. Hedge funds try not to gain or lose money in whatever market. So in rising and falling markets, they try and make money. That's the idea. Private equity. But the thing with a hedge fund, the reason why you would invest in it is correlation, but also is getting access to some of the best fund managers, because the compensation structure is so attractive that traditional fund managers, the best ones, often leave and go and set up their own boutique, and they can charge performance fees.
So you're talking about hedge funds, things like private equity,
private equity,
private debt.
Private equity is, as someone said, it's legalised insider trading. You can basically go and look at the company's books that you can't as a public investor. You can meet the management team. You can do a lot of due diligence, and you can bring in your own value creation mechanism to try and add value. And so if you can get into top quartile private equity firms, you can do very well, but comes at a cost of liquidity.
So that's things in portfolios for those of you like Partners Group, Hamilton Lane, things of that nature.
Yeah.
I guess you're setting a scene where we probably have to work a bit harder and concentrate heavily on how we put a portfolio together over the next 10 years versus what might have been the 2012 to 2021 type period of very low interest rates and low inflation. Before I throw to the floor, I can't get past this one. There's a saying that in America, excess liquidity always finds its way to Wall Street. On Australia, it finds its way to the residential property market. I noted that you didn't have a slide on that. I'll preempt the inevitable question from the floor. What's your thoughts? You talk about risks to the Australian economy, how big a part of it is. How much does that concern you as an investment strategist?
No, I'm not too worried about the property market. I think, what property is down, 9%? We're probably not even back to pre-COVID levels. So it's still up on pre-COVID levels. And, it is obviously sensitive to interest rates, but it's also sensitive to people having jobs and getting good wage rises and all those other things. And we also have migration rushing back, 400,000 migrants coming here, and property construction has got a lot of trouble at the moment. So it's probably not able to keep up
Supply
with demand. So I think property is fine. People still think it's got maybe a little bit further to fall, maybe another 5-10%, until it finds its floor. We did see March, I believe, was the first positive month since April 2022. So I think property is fine. I mean, you think about it in real terms, it's actually done a lot worse. If you take 7% inflation off the 9% fall in nominal property prices, it's actually down quite a lot more. So I think property...
But you don't have fears that we have bank foreclosures en masse or things of that nature, which is the common overseas perception of the biggest threat to the Australian economy?
Well, I rely on what the RBA, they do a quarterly semi-annual financial stability review, and they run all these models, and they say even if unemployment rises and interest rate rises, some people will lose the equity in their home, and if they're forced sellers, that will be realised, but generally most people are fine. In Australia, only a third of people have mortgages, a third rent, and a third own their homes outright. And of the third that have mortgages, 40% are at least a year ahead on repayments. So there's a big buffer that's been built up there. It's just the poor kids that stretched themselves in the last couple of years. They're the ones really, I guess, going to be hurt.
I'm seeing interest rates go from 2 to 6.
Yeah.
And that will definitely flow through to the economy. Throw to the floor. Any questions? We've got one down here, if we can. Sorry, just hold on 2 seconds. We've got a roaming mic whipping its way toward you.
So a good presentation, thank you very much, Nick.
Thanks.
I'm wondering if you're going to share that with us, you're going to mail it out afterwards?
We'll certainly send that out, yes.
That was great. My question is, are we there yet? In terms of Australia?
Well, somebody had to ask it,
So
right?
Well,
I have a particular reason for asking. One of your slides I found most interesting was where the markets see interest rates moving in the opposite direction by the end of the year. And the only major market, if I've understood the slide correctly, was the US. And the US was the one where you were saying they're least sensitive to mortgage interest rate rises. So why would they come down before we would? That's the one.
yeah, that's the market prices. So the market has one more rate rise in the US from 5, or they have a range, 4.75 to 5. So one more rate rise will take them to about 5.1 is the midpoint of the range. And then, as you can see, quite aggressive rate cuts, and a lot of that's been priced in because of the Silicon Valley Bank thing. And I think that's wrong. I think they'll definitely go to 5.25. They might even go higher, but they won't be cutting this year. They'll stay there.
View is America's not there yet, even though that chart shows it. So what about us Aussies?
The same. I don't think the RBA is done and dusted yet. I think they've got at least one and maybe more. They're data dependent, but I think the tone coming out of the RBA is they still need to hike. They said, I think I mentioned earlier, that they only expect inflation to get back into the 2 to 3% target range in mid-2025, and that forecast is predicated on further rate rises from here. So if they paused here, then it would be a slower return based on their modelling, And I think there was the RBA review came out today, and Governor Lowe looks like it's touch and go whether he'll be reappointed, and maybe that'll also alter the thinking of the board that their job's not done, so maybe they actually do.
And
do
we're
another
probably touching on that. This changed quite a bit following Silicon Valley Bank. The market expectation of where interest rates were going to go to possibly overreacted to that event.
Well, that's exactly my point.
Yeah.
We've gone from having 3 rate rises this year to none. I think that is a complete overreaction. So in answering the question, are we there yet? The answer is no. And I think it'll probably be another 6 months, maybe 12 months before we're there yet.
Just one subsidiary question to that. So if Nick's right and the markets are wrong, do you think will that impact other areas of investments and equities and all the rest of it?
What does that mean for equity markets?
Well,
what does that mean for fixed income, I guess, is the main starting point? Yeah.
Probably not a lot, because, equities rose, I think, 3% or something over March because interest rate expectations were cut. So if we were to see it reverse, then I guess that's 3% symmetrically, 3% downside for equity. So not a lot of impact.
The bond market had a bigger reaction to that than the equity market.
But, yeah.
Great. Thank you very much.
Thank you. We've got one more over here.
Just on that RBA review, is there a risk with these changes that the interest rate setting could be politicized to an extent rather than being run on fundamentals and economic theory?
Yeah.
I don't think so. I haven't read all 294 pages of the report. I sort of skimmed the executive summary.
Disappointing, Nick.
It does.
It came out this afternoon.
It does seem that they're actually trying to preserve the RBA's independence. So one of the recommendations of the 51 is, at the moment, the Treasurer has the right to interfere and overrule the RBA. And the recommendation in the report that came out today is to get rid of that, to make it crystal clear that the RBA is independent of government. So the Treasury Secretary will still sit on the Monetary Policy Committee under the new framework, and I think that's probably a good thing that there is that dialogue between Treasury and the RBA. So one isn't undoing what the other one's trying to do, so hopefully pushing in the same direction. But no, I don't think it'll be politicised. I mean, the papers have tried to put a bit of spin on it. Yeah. That,
Depends
you know,
on who appoints the board members.
yeah, well, exactly. And they appointed 2 new ones today, one from the Fair Work Commission and Alana Rubin from Australian Super. So, I mean, I think they're useful appointments, but yeah.
Good question.
You never mentioned infrastructure and renewables. Now, Macquarie's usually ahead of the pack, and they're betting big on renewables and infrastructure.
Yes, no, we definitely have infrastructure in our. I think I had a few places where it was displayed as one of the asset classes that we look at, and actually today we were actually working out how we can put more money into infrastructure and what's the best way to do that. At the moment, for most of our clients who need liquidity, we have to do it through listed infrastructure securities. So we have a manager that we work with there. But we're also looking at incorporating it for those clients that can lock their money up for extended periods, which is needed for private infrastructure.
And related to that, I guess there's the renewables element to the decarbonisation.
Oh, no. Renewables is a big part of where these infrastructure funds are investing. There's obviously a huge demand for capital in that space, and it was interesting today, one of the managers we're talking about, they said, we're funding these grid-scale battery projects, that no one else will fund, and it's very attractive returns there at the moment. So, yeah, it's definitely a big part of what we're looking at.
An area of opportunity. Probably got time for one more. Yes.
Yeah, thanks for a great presentation. What's your forecast for the Aussie dollar?
Yeah, I hate forecasting currency because you're invariably wrong.
No excuses, Nick.
So I'll defer to the economists or the FX strategists, and their view is 72 cents probably by the end of the year. So they're saying the Aussie dollar is a little undervalued, particularly given China's reopened very strongly. Commodity prices are probably higher than where they were, so that's all supportive for the Aussie dollar. Interest rates, well, who knows? I mean, we're debating whether ours certainly won't be higher than the US, but, I think that the question mark there about it. But yeah, probably a little bit higher. But my general view is I love being unhedged, particularly in international equities, because the Aussie dollar is so risk sensitive that whenever stock markets fall, the Aussie dollar tends to fall at the same time. And when you have investments denominated in currencies like the US dollar, they go up in value so you get that nice shock absorber effect from being unhedged. So generally I prefer that for international equities. Yeah.
Thank you very much, Nick. Thank you once again, everyone. Please thank Nick. Please do stay with us. Have a drink, have a bite to eat. I think we have a bit more food coming, and we've got the room for about another 45 minutes, so we'd love to have a chat. Thank you all for coming, and have a great evening.